morning, everyone. So, this is our Christmas presentation for members and investors, and we're absolutely delighted to welcome back Hedley Widdup of Lion Selection Group. And given that Lion Selection Group, Shares in Value, and East Coast Research are all heavily bullish and strongly exposed to gold, we've really decided to keep today's webinar primarily about gold and also maybe a few sprinkles of other stocks. We're working on a really tight time window, so I apologize that we can't cover every topic, but we've really focused on what actually matters right now and some of the topical and the movements in the market. So welcome, Hedley. How are you?
I'm good, thanks, Gia. It's nice to be talking to you again. I really appreciate you making the time to have a chat.
Well, look, we've had so much to do with each other over the last year. I think we both owe it to each other to discuss how your year ended up and what you think is going to be happening in 2026 for our members, investors, and the market. So let's start off. Look, I know that a lot of people really, really hate to ask you a lot of these, crystal ball types of questions, right? So I'm not going to go and do that, but I do want to reframe it a little bit. Okay, gold has been the biggest commodity on our mind at the moment, and I believe that last year that you made some fantastic picks. So can you please just briefly touch on what has truly actually happened in 2025 and where you see it headed in 2026 for commodity, particularly in the gold and the rare earth sector?
Yeah. Mining is an incredibly cyclical business, and booms probably last much longer than busts, and the busts blessedly tend to be shorter, although the last two which have occurred have been quite long and protracted. But I think most investors realise that the mining space goes from boom to bust to boom to bust. It's cyclical. It's always going from one to the other. The greatest curiosity that I come across, particularly with a lot of retail investors, is that they just find it difficult to know whether it's early in a boom, late in a boom, are we in a bust? Because this is, and I think they realize as well that the most material influence on your investing experience in this space, particularly if you're investing in explorers or developers, is going to be this cycle. If you invest at the top of the boom, and that's where you put all your money into the market, you'll get wiped out and you'll have a negative experience. Conversely, if you manage to be investing close to the start of the boom, then you're going to have a much more positive experience. So this is something we track extraordinarily closely in our business, and we're watching a number of things, but the things which kind of give you a sense as to whether it's booming or busting. You can look at some charts, and if you
And
look
the
at
lion clock, right?
well, building towards this, right? Because the lion clock tells a story of this cyclicality, and the reason it's on a clock is because you do see the same thing happen time after time after time. It goes round and round and round. What we're looking for is, what are share prices doing? Share prices, particularly by the time you pull them together into indices for, large cap mining stocks, that will tell you. You can look at that and you can say, okay, I can see the boom and I can see where the bust kicked in. The puzzlement is, though, do you sit there and go, well, that line has gone up for 5 years. Does that mean that we've got another 5 years left? Does it mean we've got another 10 minutes left? It's not particularly diagnostic. So we watch investing patterns and we watch the patterns of money flowing in or out, because that's where the diagnosis comes. And we're looking for evidence of more money being invested in the market, or is it a selling behavior that's taking place? So I think that the slide that you're referring to now, the year the mining boom began, is we've looked at liquidity through the last few years, and we've seen a change in the behavior of what's been going on in the market, and that's been driven by something which is probably fairly obvious to a lot of investors. You can see there's a number of lines on that page. There's two big ASX indices, the ASX 100 split into resources stocks and industrial stocks. Now, the industrials contains, the supermarkets, the banks, even the tech stocks. It's everything except for the resources stocks. That's the way the ASX tends to divide its big indices. And for probably a couple of years, 2 or 3 years on that page, the resources stocks had underperformed the industrials. The industrials had just kept going up. The resources had peeled off. Now that kind of underplays how this phenomenon has worked globally, because if you looked at Rio Tinto, BHP, they haven't fallen as much as the global miners that are based elsewhere. If you looked at the Glencores or the Anglos or the Tecs, they've gone down probably 50% from their peak in circa 2022 to their lows in 2025. BHP Rio, it's more like sort of 25-30% that they went down. If you look at a lot of smaller companies, it's a much more pronounced fall. So what we've been watching for is when are we going to come out of this bust? When are we going to bottom out? And because when you find the bottom of that cycle, you're going to start going up on the other side. And that's what we've been watching for, knowing that it will come because all cycles come around to the next boom phase. So we knew it was going to arrive. It was a question of when. The red line, which is right at the bottom, is 600 odd junior companies, and we've just taken a median price change over that period of time, and you can see that they've crashed. They've fallen by about 80% in circa 3 years. They hit their top in 2021, and they've had a bottom in 2025 as well. And then we've broken out some gold juniors from that population. That's the gold coloured line, and it's gold which has led to a change in sentiment, I think, towards people investing in this space. It's tempted people to come from big companies into small companies and prepared to take the risk on more risky ventures. And that's been led by gold companies. The behavior that we're seeing now, though, is I can see people saying, well, maybe we should be investing in some exploration companies that have got copper or development in copper. And the reason that's significant is the copper price fundamental hasn't really changed for the past probably decade. It has bumped up against the same price level. Fundamentals now are very good, but copper has had excellent fundamentals for a while. But between 2021 and 2025, copper exploration, copper development was just as hard to fund as it was for gold and anything else. And the copper price hasn't moved up as aggressively as the gold price. So for investors to be saying, well, okay, gold, good, we've speculated on that. Let's speculate on copper. Let's speculate on a few other things as well, suggests to me that this behavior is spreading out. And there's a more diagnostic feature to show that money is actually targeting this space now. And I think it's probably on your next slide, Gia, which is also called The Year the Mining Boom Began, but it talks about initial public offerings on ASX. The reason that initial public offerings, IPOs, are so diagnostic is that IPOing companies don't have a history. They're looking to list on the exchange for the first time. They start off with a very small number of shareholders. They're trying to take on all the shareholders they need to list. They need to raise money to get themselves on the exchange. And they need to do that in a short window of time based on a single document, their prospectus. It's hard to list a company because those companies have no track record at the point at which they're trying to list. And your ability to raise the money to get yourself over the hurdle to get this company listed on ASX comes down to whether or not there are investors that are happy to take that plunge. It's different to raising money in an equivalent but already listed company because an already listed company has a track record. There's a sense of whether it's cheap or expensive because of what its share price has done. And you can see whether or not they've delivered on promises. You can see what they've announced they're going to do, what they've then delivered, etc. So to list a company in a good market is a lot easier. And in years gone by, ASX has had up to 100, 120, 130 odd IPOs of mainly exploration companies in those hot years of the booms. In between 2021 and 2025, we've seen that trend fall, and 2024 was like a low year. In 2025, we've actually had more IPOs of exploration companies onto ASX than we had last year. So that's the first time that trend has been broken. It's nice to see that break. Just the number of companies isn't the immediate tick because you go, well, okay, number of companies is one thing. Have they raised more money? Generally speaking, that pattern of the amount of money raised and the number of companies listing is a similar shape. So the first answer is, yeah, probably they have. But having worked out the amount of money which has been raised, that has actually eclipsed the 2024 tally as well. And the fascinating thing about that is that there were zero IPOs onto ASX for exploration companies in the first half of 2025. So for 2025 to have already pipped 2024, it's been done in half a year versus a full year for 2024. So I think that pattern is very, very strong. That turnaround of the IPO trend shows that money is coming into the space and it's more tolerant to the risks that it's going to speculate on in order to back IPOs. Granted, most of those have been gold focused,
Mhm.
But in the secondary market, where we can see people speculating on other companies and backing secondary raisings, we can see that risk appetite spreading out as well. So I think that's that test of liquidity, and it's liquidity which winds the clock. It's liquidity which turns the cycle from falling to lifting again. I think that has turned a corner. So that's incredibly significant. And that's the marker for me that we've passed the bottom, which means that we've entered the new phase, which is a boom.
Fantastic. I mean, coming back to the line clock, which I believe your father actually created this.
He did, yeah. The pioneer. It was his concept. Uh,
Um, so tell us more about this clock and where we're at. Obviously, we're sitting towards the upswing now. And how can investors and our members capitalize on this now, knowing exactly where we sit, and how are we different to the previous booms?
yep. Well, the lion clock is a concept which dates back to around 1987, which was when Robin, my father, joined JB Wears, and I think this is a concept which sort of came to him to explain to retail or high net worth people that didn't have a resources expertise to talk to them about booming and busting and how those cycles all take place. It's a concept that came with him when he left JB Wears as an analyst, and he came and started Lion Selection Group in 1997. And it's a concept that we've run with in order to talk about how we see the market in that whole time. So Lion is in its 28th year now,
Yeah,
and it's a concept which is still a strong part of our branding. Um, 12 o'clock midnight is when the boom stops and the new bust starts, a crash starts to happen. And we often talk about the sort of the Cinderella analogy. It works well. There's 24 hours in a day. We know that this clock has only got 12 hours. So we tend to align that 12 with midnight rather than midday. And midnight, of course, was when Cinderella's coach turned back into a pumpkin and her dress turned into rags. Um, it's a concept which a lot of people can sort of instantly align with if you use that analogy. 6 o'clock is the bottom. So that's when we're rounding off and saying, right, it's time to start the new boom. So if we believe that we're going through 6 o'clock, that's what we've said is the feeling. And the reason we say moving through 6 o'clock rather than it is 6:30 or it is 5 past or it is 7 o'clock is because when you move through the bottom of that cycle, we've been dragged in by gold. People have been attracted to that. That's enabled capital raising. But the gold price softens, capital raising trends soften a bit, and you probably see these share prices fluctuate. Really, I think the defining point as we look back at this is going to be where share prices have leveled out and meaningfully edged up. We've seen that happen in gold. It hasn't
yeah,
happened yet across the whole sector, although those indices that I mentioned before have been in an uptrend since April, which I think is quite significant. So, we've got some fair confidence we're moving through the bottom. We might look back at right now and say it was 7 o'clock. Right now, we've got to make that call. So we're confident enough to say we're moving through the bottom,
mhm,
and it's a question of how far past it. I don't think very far past. So the outlook that provides is in the boom, there's money coming into the sector, and investors typically won't have to stress that they're going to be the only ones trying to invest in companies. And booms tend to last for years. I don't think we've had any mining booms which have been only a year long. Typically, they're more than 5 years. They can be 10. So the excitement for us is that all of a sudden you've got this outlook of the future, which is the probability of some robust investing years where the investments that you make get strong recognition from the market for the news that they announce. Commodity prices are probably fairly supportive, and as companies progress, they're reliant on the market rather than just us to be able to create or find the funding that they need in order to progress themselves, go on to the next level of activities, build projects, if you like. For investors, then, or general investors, I suppose it brings about the second conundrum, which is what
mm,
stocks do you want to pick? And I think Shares in Value, East Coast Research both offer a bunch of stock picks that people can read through. Lion Selection Group does that we invest in companies. So we're making our picks for ourselves there. And I think for a lot of investors, you just need to determine, do I have the confidence to invest in these companies myself? In which case, you use the resources of a research organization to help you with those. If you don't have the confidence, then that's the exact type of investor which line pitches to. And everybody has a very different risk tolerance to be thinking about how they want to go about doing that. But by investing in that part of the market, you are taking on new risks. Companies like Commonwealth Bank, Woolworths, they don't need to raise money. They have sustaining businesses which provide, all the revenue they make pays their costs and some more. The risk at the bottom end of the market, the juniors in the resources space, is in most cases they're exploring or they're hoping to develop a project. They don't have any source of revenue, which is why their prices react so strongly to this cyclical influence. In the bust and their ability to raise money disappears, their value crashes. But in the boom, of course, when their ability to raise money and be rewarded for positive progress, it can cause their share prices to go up quite strongly. So I always feel a bit funny when people say, "So I could just be investing anywhere in this space. The rising tide will lift all boats." To some extent, that's correct. A lot of companies will go up, and some of them will go up unfairly. You need to be very careful about those stock selections still. All the principles of picking good companies with the right people absolutely stand. But if you're wanting to speculate, then this is the time that I think speculation can be richly rewarded.
Thank you. And now, look, we're onto the slide around gold. Obviously, I don't want to push for some crystal ball predictions, but I do understand when you spoke on another podcast, I believe last year, you did obviously make a statement about where gold was sitting. Do you think in 2026 the trend and the direction will continue to be positive, and how can our investors maintain to continue to get exposure to that trend in the commodity cycle?
Yeah, well, the thing with gold is it's gone up incredibly aggressively during 2025, and I think come the end of October that pulled back a bit. It left a lot of people, and particularly if people are listening to this who they think of themselves as generalist investors, they've probably got a portfolio which has got some banks, some supermarkets, some big industrial businesses, some biotechs, etc. And their gold investments, I'm sure that in November would have pulled back possibly quite strongly. There was even producers which came back circa 15%. Now you can imagine if something like Woolworths came back 15%, it would be all over the media and it would be like this company might be screwed. Like to have a pullback like that in a big stable business suggests there's a problem. In the gold space, this volatility is, I won't say part of life, but when you've had an extremely aggressive run up, you get to a point where the price then goes, oh, I'm going to have a wobble for a minute. It causes share prices to react quite strongly. And I think across the board, we've seen stability come back to the gold space, but it would have raised these questions, particularly if someone's looking at their portfolio and going, there's two companies here which have fallen and they're both gold companies. They both must have individual problems. In reality, it was the gold price which had affected them and brought about this change. When I talk about or think about the gold price, though, I find it really hard to think short term because gold reacts to changing conditions over time, and it tends to be that the reasons why people want to own gold pile up over time as well. So the chart that we're looking at is the gold price going back to 1960, and it's got three big bull markets drawn on there, and what I'm trying to point to there is that when gold goes up, it goes up in multiples. So you've had one event which went up 18 times. I'd argue that at the start of that process in the early 70s, gold had been pegged to a certain price in the US dollar, and it was probably unnaturally low. So unpegging it gave it the ability to move up, and it didn't move up that quickly, but it did start to move positively from that point onwards, which suggests that give people the ability to own it, give them the ability to buy it at a market price that they think's fair, and if they think that's cheap, they'll keep buying it. That probably started that bull market. It was compounded by inflation, but that inflation was a product of oil price moving up dramatically. It went up by a factor of 10 times in less than a year, which, is inflation that the whole world feels. And it was during the Cold War. Now, the Cold War lasted from the end of the Second World War until the early 90s. And through that time, a lot of people, and particularly central banks, which diversify their national savings across different currencies and gold from time to time, they needed to own gold, which was a hedge against all of the uncertainty in a war, which is overhung by the possibility of a
mm,
hot war and the possibility of nuclear participation in that, which drives a lot of nervousness. That particular gold market ended when production quite well. I think production kind of ties into this as well because gold supply people don't think about much. I think because gold sits in vaults, of all the gold which has ever been produced, most of it sits in vaults. The thing is that most of it tends not to trade. What gets purchased in a year tends to be the gold which has been produced within that year. So if
yeah,
gold supply is falling, you actually find that the market is tightening all of its own accord. So that early or that 1970s bull market saw gold supply falling as South Africa, which was the biggest producer in the world, was reducing its output. And that wasn't replaced by anything. It wasn't that South Africa was overtaken by anybody. It's that South Africa was falling all on its own. And that's because of the assets getting harder and harder. Um, when that production flattened out and then, in fact, was able to increase slightly, I think you probably saw the gold price uh, get some additional supply coming into the market, and any tightness which existed just started to fall away, coinciding with inflation being absolutely smashed by the Fed aggressively lifting rates in the early 80s. And I think everybody probably knows the story from there. There was a period of time where production increased rapidly. And that was due to a form of processing called CIL and CIP, carbon in leach or carbon in pulp. And that made a lot of material that would have previously been waste economic. And it was economic against the tide of a falling gold price. So this was enabling a massive expansion of gold production globally. And that overprinted a long period of time where the gold price remained flat.
mm,
The industry was hedging, which means it was selling more gold into forward products. Um, and that went on for a period of sort of 10 years. It was overprinted by central banks selling. Central banks didn't want to own gold after the end of the Cold War. So in that sort of period of a Goldilocks decade where everything was perfect in the biggest economy in the world in the US, balanced budgets, there was very little conflict in the world. The need for gold kind of disappeared. And I think a lot of investors moved away from it, but led by central banks. Um, in the early noughties or the late 90s, we had a couple of dramatic changes in the global world order, but some of them pertain to the global financial order, and that fed directly into the gold industry. So we had Enron in 1999, and the Enron scandal was basically a balance sheet that was chock full of derivatives, and they imploded. The masters of the universe that had put Enron together didn't understand, or perhaps they did or had concealed the risks that those derivatives contained. And when they imploded, it took the whole of the Enron company with it. What the fallout of that was that derivatives on balance sheets generally began to be looked at in a fairly dim sense.
mm,
And gold companies had high levels of derivatives on their balance sheets because they'd been using these forward sales to hedge the gold price, and they were selling into forwards because through that period of time they were able to get a higher forward price than they could in the spot market. So piling up these forwards on their balance sheet made sense until it didn't. And in the late 90s, they found themselves with collectively about 12 months worth of annual production of the entire industry was held up in forward sales. And they needed to be unwound because all of a sudden the financial world was saying, these derivatives don't look good and we're very suspicious of you. So as the gold industry started buying back their hedges, they became one of the biggest buyers of gold. That began moving the price. Uh,
mm,
and we saw a bull market happen off. So that was the second one, which 7 times over the entire span of the bull market. But I think you could almost say it was two bull markets, one following another. We had the global financial crisis in 2007, 2008, and that was something which brought about something we've never ever seen before, and that is economic stimulus that's been delivered via money printing, quantitative easing. This happened in the West. It happened in the US and Europe. And I think a lot of the BRIC nations, Russia, China, India, Brazil, there's actually a much longer list than just the BRI and the C of that now. Saudi Arabia, Turkey have added themselves to that list. There's a number of them. I think they observed this and thought to themselves, it doesn't look as if the West can use austerity anymore when economic troubles arise. And the global financial crisis was so big and sudden, and it showed that the economic fallout was generated by the failure of institutions. So this stimulus was delivered, I think, to deliver confidence into the market and to protect things which, for the first time ever, had become too big to fail. But that was the turning point for central bank buying, because off the back of that, BRIC nation central banks became fairly large collectors of gold and have been since. We've seen a lot in the media about that in this recent bull market because, in the last 12 months, China buying gold has hit headlines. They've been
Mhm.
doing that since 2006, 2007. So I don't think that China is what has caused this. But when central banks are buying gold, it absorbs a lot of that annual supply and it just provides tightness to the market. So if there's any other reason for anyone else to be buying gold, it's going to move the price. And what we've seen in the last 2.5, 3 years has been aggressive buying of gold. I think you could probably say by people who are seeing the de-dollarization or a lack of confidence in the US dollar accelerate. If I was to say this 3 or 4 years ago, you might have rolled your eyes and thought I was a bit of a conspiracist, but it's making mainstream media now. In 2022, Russia invaded Ukraine, and
Mhm.
quite a lot of Russian assets that were denominated in US dollars were confiscated by the US on the basis that they said, well, if you're going to invade Ukraine, we'll just say you can't use US dollars anymore. So any US dollars you have, come back to us, or maybe we'll confiscate yachts from oligarchs because it's an access to their US dollar, proxy US dollars. Um, I think that's changed the mindset around how a lot of people, groups, investors, central banks, etc., view US dollar treasuries that they might have in their sort of asset suite. Because if you suddenly find yourself on a fouler footing with the US, those assets might disappear or you might find them harder to deal. And I think that's really changed the way that a lot of people look at gold because it's a fantastic second thing that you can have, build central bank foreign reserve assets with gold without having to worry about what your relationship with the US is. Now, I don't think that's the single thing which is driving it, but a lot of investors have kind of swung in behind this. And in the last 3 years, we've seen that squeeze with 2025 being the real driver. So reflecting on all of that, that's a long answer to a question. Do I think the gold price has positivity to it? Is perched at a level which is unnaturally high, or is just
Mhm.
going to go sideways from here? I think you can eliminate sideways because the gold price very rarely goes up and then goes sideways. It
Yep.
either goes further up or down from there. Is it going to go down? I think with the summary of sort of drivers of why people have been wanting to accumulate more gold, it's very difficult to see it going down or correcting by a long way from here. So I think the default answer then is it's very well supported. But is 2025 a template for 2026 in terms of what price performance could
Mhm.
be? No, I think 2025 has been an outrageously strong year for gold. I think it'll be positive in 2026, but it doesn't mean to say that I could see the same. What are we up? 50, 60, 70% on gold price in a year. I don't think we'll see that in 2026. And in fact, I'd be very happy with anything that's less than that, still a positive number. So, it puts the gold industry in very rude health. And I think for that reason, sitting where we are and just going slowly up from there is much more expectable.
And a lot more stable for the business in general, right?
Yeah, well, any strong gain suggests that there's going to be a correction at some stage. And what we saw in late October was gold price sort of had got so far from its long-term moving averages, it hit a point that I think we've seen a correction most other times. The gold price has moved so strongly away from its moving averages. Those things have a tendency just to level out for a period of time. So I think that's what it was. It's the looser money in the gold market has said, "Well, stop, just gone too far, too fast." But the long-term drivers, I think, remain very robustly behind it.
Thank you. And now, look, we want to talk about copper. I know it's not as favorable at the moment. So, can you, on this chart, just outline for us where copper is headed for 2026 as well?
Yeah, sure. So, the chart here has got a reasonably near-term history of the copper price. When
Mm.
I look at copper, I often look at it right back to 1970 just to see how it's changed and where it's where it was trading up against a barrier. There is a big difference that we need to explain between gold and copper, and in fact, there's a difference between gold and just about any other commodity,
Mm.
because gold isn't consumed. Most of the time, it gets purchased and it goes into a vault.
Yep.
There are consumptive uses of it, like jewelry and dentistry and electronics, but they're a small part of that market. So, and it plays in with is all of this previous production just an overhang on gold? And what I've explained is it tends not to be. Um, so, with gold, if a party or an investor is motivated to own it, they're not looking at it going, I need to be able to pass the cost of purchasing that gold onto the end user of the product that I'm going to put it into.
Right.
Rather, those buyers of gold are motivated by wanting to own it, and they're not as price sensitive. They're definitely sensitive to, oh, I could have had it for $4,000 an ounce and now I've got to pay 4,200. But in the scheme of things, if they're motivated to own it because they're worried about something, or they want it as a hedge, or they want it so that they can protect themselves against volatility, they're not going to be as worried about the price. Whereas someone who purchases copper is far more often than not going to be someone who wants to use it in an end use product, or they're a short term trader, in which case they're not going to buy it to hold it for 2 years because they've probably used a futures contract to purchase the exposure. So they'll be motivated to turn that over in a short period of time. So copper, like many other commodities, will have a point where it becomes so expensive that it's difficult for those people who purchase it to use it to hand that on to end users. And I think that's what we've seen in copper for roughly the last 20 years. In 2005, 6, copper found itself trading up against a level which is only a couple of percentage points beneath where we are now. And we're
Mm.
trading at reasonably high copper prices historically, but it's never managed to punch above that level. Um, there's been volatility that's kind of edged that maximum up, but it's never been able to break what looks to be a fairly long-term roof. Now, that 20-year period, we could lift that up and dump it back in the 1980s and 90s and see very similar behavior. And we could dump that in the 70s and say, well, we can see a similar price that bumps up against and then somehow smashes up through it, establishes a new paradigm. And what 2005 and 6 was for copper was the Chinese economy becoming the biggest purchaser of copper, needing to have a lot of it and pushing the price to a new level. But that pain threshold that was achieved in 2006, every time we've hit it since, we've kind of fallen back from it because of that. The interesting thing about copper then right now is that we've seen three very large disruptions in supply. There's been accidents and incidents which have taken place at three very large suppliers of copper. One in Indonesia, Grasberg, a tunnel collapse. I think that is very significant. I can say a tunnel collapse, but the way it affects that mine is extraordinarily significant and unpredicted based on the way it's happened. Kamoa-Kakula is a big mine in the DRC. They
Mhm.
had a seismic event which has reduced their ability to make and sell copper. And El Teniente in Chile, which is an extraordinarily large mine, also has had, I think it was a mud rush. But these are all events which are generated by the ground moving in a way which you don't expect, and that has reduced the amount of copper which can come from those three very large producers. So all of a sudden, we have extreme tightness in the copper price, in the copper market, I should say, in terms of supply. But on the demand side, we're moving into a market where there is more and more and more brand new demand, which is brought about by the proliferation of data centers and
Mm.
contributed to by decarbonisation and electrification of the world. So these new demands don't add much individually, but they add a great deal when they sort of add up and all coincide in time. And probably the part of that which appeals to me the most as a short-term driver is this whole AI data center intersection, because AI right now it's a war of who can get there first, who can proliferate the largest data center, who can develop that the fastest and have that in place. They're going to win in some cases in terms of nailing the fastest, smartest set of algorithms that gives you an AI service. There'll be others which come along and they're all competing and they'll probably all take a part of the market, but they're all trying to get there first, which is what's putting an enormous short-term demand squeeze on copper, just at a point where supply is constrained. Now, in 10 years' time, I'm sure there will have been many, many other demand contributors, particularly from the electrification side of things. But even going back 3 months, I would have said that this demand squeeze could be further out. What it looks like now is that we've got the best set of circumstances we've seen in the last 20 years to push above that roof. And some of the behavior we've seen in the copper market does look as if we could push above that roof price. And if it breaks out of that, well, as they say, sky's the limit. But if we push into a new copper pricing paradigm, that might be a new paradigm which is with us for some time. And what effect that would have is unlocking sources of copper supply, new mine feed, which just hasn't had the incentive pricing to. Sorry, I'm talking in phrases which are probably a little bit. I'm not assuming anyone understands what incentive pricing is. If the price of copper is $11,000 a ton,
Mm-hmm.
and a big new mine, which could satiate a big part of this demand, needs a price for it to be able to develop to be economic of above $11,000 a ton. The further you go above that, the more of an incentive there is for that new mine to come on, and the more you'll get new money chasing it and providing the funding it needs to be able to build it. So, incentive pricing being above that cap is something that we've talked about in mining for a long, long time, and now it looks to be having a good chance of happening. Now, I can wave my arms around. I think it looks the likeliest it has for quite some time. But in 6 months or 12 months' time, we'll know for sure. So it's a bit speculative, but it is quite exciting because this overlapping with the start of a boom tends to make me think that there could be a few other commodities which feed into this and also get a bit of a leg up over time.
Thank you so much for such an articulate response here, Hedley. Now let's go into 2026, which all of our investors are eager to hear from you about. We have both come up with some picks between us. So let's start off now with Antipa. Like, there's a name that's been gaining a lot of attention. So why don't we talk about that first?
Yeah, sure. So whenever I talk about stocks, I try to let people know if I'm conflicted by saying if we own it or not. And
Mhm.
secondly, in addressing it, everybody has different ways of looking at these things, and they all have their personal risk profiles that I don't know anything about. So I prefer to sort of say, here's what I think the risks are, and here's what I think the opportunities are, and then they can blend that with their own personal investing outcome. So Antipa is a company that we own. So I've got to say, ding, 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 part of our portfolio there. Look, they've had the last 18 months has been sensational for them. There's been a series of things which have kind of contributed to their success, and some of it
Mm,
outside of their sort of orbit, some of it inside their orbit.
mm,
Um, they've been exploring in a remote part of Australia for quite a long time. They've amassed a very attractive looking resource there. And when we invested in them for the first time, they'd defined a project, something that they thought they could build, and they'd done some preliminary studies on it. So that was what attracted us. Big metal inventory, and a couple of people who we think the world of, who we thought were going to do a fantastic job of progressing it. The thing we had in the back of our mind was that it's about 40 odd kilometres from a project called Telfer. At the time, that was owned by Newcrest. Newcrest got taken over by Newmont, and Newmont put Telfer up for sale. And our thesis was if anyone buys Telfer, they may then get interested in who is in the rest of the region, particularly because there's mineralization defined sitting here in Antipa that the natural kind of one of the natural places you could think to process that would be at the existing Telfer process facility. So we invested. The market started to speculate about that concept and whether there could be consolidation as Greatland Gold bought the Telfer project. So I think the valuation of Antipa got swept along with that speculation. It certainly hasn't hurt them that the gold price has gone up strongly in the same time, and that's taken the economics of what they had at their project from good to great. They've also added to the metal which they've estimated in their inventory, so the project's got bigger and improved. I think probably the threats then for Antipa are: does the world stop speculating about whether or not they could get taken over?
mm,
I think there's many ways for Antipa to commercialize what they have without getting taken over. That might be building it themselves, or it might be just selling ore to Telfer, or it might be that Telfer says, "Okay, well, we need to own all of this." It's a little bit difficult to see exactly which of those it would be, but I think the fact that the market is speculating about it suggests that there's a fair bit of logic that lots of people see. Um, I think a very rational and reasonable fallback would be that they build the project themselves, and
mm,
the outcome of all of this is that they've been able to fund themselves. And sometimes when the market speculates about a stock, what it does is it puts them in the spotlight once the market knows about a stock because it's in the spotlight, it gets a life of its own. And it looks to me as if that's something that could happen to Antipa. They're funded right the way through to being able to make a decision to mine. So that gives them plenty of time to add more metal, finish their studies. And the best thing I think for them is that they don't need to worry about raising money until they're well past the point of knowing what it is that they'd like to build.
And look, I've heard through grapevine that, look, you said that they can very well progress into production themselves, but what is the likelihood that there could be and will be a takeover target? I mean, 2.9 million ounces of gold in Paterson is nothing to joke about. What's your take on that?
Well, just to put some basic numbers to it, and I should emphasize, I'm really only going on the public information that exists around Greatland Gold. I don't know those people, and I and that's not so much that I want to try and say I haven't heard anything. It's more
Mm,
when you start to talk about takeovers, it can seem a bit rude when you're talking about a company and saying, here's why they need it so badly. So I think the pieces which have contributed to people speculating about Antipa being a takeover target are
mhm,
at Telfer, there's an existing process facility that can process a huge amount of ore in a
mhm,
year. So the question is, can they keep that full? There's no point having a process facility that can do X amount of processing in a year and only keep it a quarter full or half full because there's so many inefficiencies that sneak in and wreck your cost structure. So the logic suggests the fuller that can be, the better. Between existing known material at Telfer and processing Greatland's project, which is Havieron, which they'll be trucking in, it looks like they could keep that mill half full, and you can sort of turn half of it off. So perhaps there's economics for them to do that. But there's a very, very logical combination to be bringing in a lot of tonnage from where Antipa is, and that
mm,
would go a long way towards this cost efficiency at Telfer being in place. It looks as if the metallurgy is quite consistent, so you can use that plant to process the Antipa ore, and it looks as if Telfer is considering a range of plant reconfigurations and upgrades from the pre-feasibility study that they've brought out over their own Havieron deposit. So it looks as if that plant will become a little bit more versatile in terms of processing different ore types as well. I know for a while there was talk in the region about whether the two were compatible metallurgically, and it looks as if Antipa's material is quite compatible with that plant. So you're right. 2.9 million ounces is something which is considered, quite strategic, I think, particularly in the Western Australian industry, where the thought of developing another process facility within 50 kilometres of an existing very large one would seem strange. You'd think that at some stage that logic might push the two together. I guess the conundrum then is, flipping that on its head.
mm,
Why would Greatland do that if they think they can fill their process facility themselves? And I think time will tell. They probably know better than anybody else what confidence they have in their own exploration, and it looks like something they need to deliver on in the next year or two to prove to the world that they don't need to buy something. So I think in that time frame we'll get a fair perspective over whether or not. But for now, I think a lot of people, a lot of investors have seen that and consider it an exciting thing to be able to speculate on. And I don't think that they'd be wholly disappointed if Antipa then decided to develop a project as well. So, two very, very strong pathways for Antipa to consolidate the value which exists. And I guess probably the last thing I'd add there, particularly when you're thinking about, we've talked about the threats,
mm,
in terms of opportunities, they sit on, I think it's about 4,000 square kilometres of exploration ground, which is an enormous patch of ground.
mm,
Uh, this region, the Paterson region, has produced two extremely exciting new discoveries of mineralisation. Havieron, which is multi-million ounces of gold
mm,
and copper associated with it, as well as Winu, which was discovered by Rio Tinto, a very, very large copper system. I think this is an area which has giants, and those two discoveries eclipse most of the things that have been found in the southern part of Western Australia in terms of gold in the last decade. So, to have had those both occur in this area, which really doesn't have the density of mines that exist through the southern part of Western Australia suggests that this area is quite prospective. So to control so much of it,
Mm.
Antipa has an enviable pathway in front of it. Just this morning, they put out some news to say that they've had some very encouraging results from a prospect which is not where they had been focused. So they might have a new discovery on their hands as well with 35 odd meters at 1.5 grams. So fantastic start for what could be a satellite ore feed all of their own.
And Hedley, look, you're an incredibly intelligent man. So, how long has Antipa been in your holdings?
I think we first invested in this one in I'm going to say 2023. The date escapes me. It was either
Sure.
later in 2023 or earlier in 2024. So I think I'm going to go with 2023 for now. I should have researched that first, but so we're about 2 years into the journey with Antipa.
Look, Brightstar at the moment, look, I want to really address the elephant in the room where I believe their share price has not truly reflected the value that is actually inside their business and what is upcoming for 2026. Can you talk a little bit more about that for us?
Yeah, sure. Look, like you say, it's one of your personal favorites. It's if I was to, and I'm not sure if you had this slated in for asking later, but there's two of these stocks that I would say 2026 looks to me like it's going to be their year, and Brightstar is one of them. So, and there's a couple of reasons for that. First of all, we're attracted to projects and people. So, ding,
Yeah.
ding, ding, we're an owner of Brightstar, and I get that conflict out of the way. They've I'll address kind of the risk side of things by saying here's how
Mm,
they've traded in 2025. I think Brightstar kind of hit the stage 2024 as they were collecting a few assets. They had a very energetic managing director, Alex Rivera, who moved into the company and he's rejuvenated the board as well as the asset suite, and he's been building the company. The thing is, a lot of the market will say, okay, well, you've transacted, you've raised money, now it's time for you to deliver success. And I think that probably the market got a bit ahead of itself in terms of just how that was going to transpire.
mhm,
What Alex has done really well is pull together some assets which can be developed smaller scale and deliver cash flow. For me, that's kind of the character of the company, but it's not the story. That's what the market's been focused on, and through the first half of this year, I think the market sort of said, "Well, hang on, mate, you're actually not making any cash through this. These smaller assets, are they actually any good?" And it caused a lot of people to question it. I think if you go back and look at the way that Alex had told the story in 2024 and what to expect in 2025, the first half of the year being mainly cash burn was exactly what he'd foretold. The second half of the year was going to be where that cash harvest really came into play, and that's exactly what's worked out. So the June quarterly looked really tight. The September quarterly looked fantastic. There was an overpinning on this though, where mid-year, Alex announced a feasibility study for the next stage. So instead of having these small assets, which were just going to be selling the ore, they would develop their own process facility, which could unlock a bunch of other assets in the same Laverton area.
mm,
And when those numbers came out, I think it just laid on top of you're not making any cash. And
mm,
when that happens, the market starts to think, oh, you're going to have to raise money. Now, Alex has time and time and time again pushed into new areas, got people to look at the stock, understand the story, and he was doing that. They also had a strategic rationale, which was to merge with a company or take over a company via a scheme of
mm,
arrangement called Oramin. And this part of the story is the part that I think has the value, right? So
yeah,
in 2024, Brightstar took over a company which we were already investors in called Alto, and that delivered to them a major strategic holding in a place called the Sandstone Belt.
yeah.
Now, Oramin, and I'm using my hands here, Alto had one side of it. Oramin had kind
Mhm,
of the smaller but neighbouring portion, and between the two of them, they held most of the sandstone greenstone belt. Now, I'm using a bit of terminology there, but there aren't too many companies. In fact, I don't think there's any in Western Australia that would own the whole of a greenstone belt. And greenstones are where gold occurs in Western Australia. That is the size of this sandstone belt. But I'd add to that, the sandstone area has seen 4 million ounces of historical production. That's a very significant amount. And I
mm,
think that most of that has been mined from it would be less than 50 meters from the surface. There are some deeper workings, but the bulk of that 4 million ounces has been from essentially very, very shallow mining. What we know from other areas where big ground positions like that have had a big company come over the top and invest properly to drill, extend things down, establish new mines, is that they go on and on and on. So when I think about the endowment in that part of the world, I think Alex's resource statement for the sandstone area is 2.4 million ounces as it stands, which is pretty significant. I don't think of it as a 2.4 million ounce story. I think of it as a 5 million ounce story or better because they have a huge opportunity in front of them there to extend that. And I think in 10 years' time, I don't know who owns it because this becomes a target in my mind at some stage. But Brightstar has the opportunity to turn that into something far, far bigger. So what they're doing in Laverton now has maintained this opportunity. It's given them the chance to be able to direct free cash that they're making from Laverton into those assets at Sandstone. And that means that they don't have to consistently raise money. But when they took over Oramin partway through this year, I think Alex had just started to get more and more people looking at the story. And then to do the Oramin deal, and there was reasons why it had to happen at that point. I think there was a risk that it could have gone away and found a life of its own. So had to act then. All the buying which was on the screen and people who were looking at Brightstar got taken into a fundraising. And when you do that, you just all the selling which is there doesn't stop, but there's no buying to fill it up. So I think this volatility, which a lot of shares in value people have asked me about, has been down to that. Now, where they stand is by the end of this year or early next year, they're going to be talking about here's what the Laverton project looks like in terms of funding. They were very, very close to that as they were moving through the second half of this year. And if you read through his presentations, you can see where Alex has been showing, we expect to be able to fund this development. We've got cash coming in, and we're talking to people about debt. That's going to put them in a position where they can say, we're funded for the development of Laverton and we're working hard at Sandstone. So the reason why I think 2026 is going to be the year for Brightstar is they're going to be revealing what a resource looks like when they upgrade that for Sandstone. And they're also going to be revealing the economics which they think can sit over the top of Sandstone. And they're going to be a company which is, approaching stable cash flow of its own with this enormous development asset sitting within its portfolio. And I think that's where the penny drops for a lot of investors that, they can see the volatility is behind and the way forward there is going to be about the excitement of Sandstone. So a 5 million ounce story in my mind, progressing and becoming quite clear to the market, particularly as it's got a guy like Alex being able to tell that story. So, we've seen a rough ride during 2025, and that's when the gold price has been going nuts, and a lot of other companies have been hitched to it. There's been reasons why Brightstar hasn't been carried along with that, and I think a lot of that comes to bear in this next 12 months.
What really stood out to me with Alex was that he wasn't a speculator. He was truly building a business.
Yeah. Well, and if you look back through the announcements, you can see he believes that because a lot of managing directors get exposed to their own stock via performance rights or
Mm-hmm.
zero exercise price options.
Mm-hmm.
Alex was buying shares in the market, spending his own cash. And, you look at how managing directors are paid. He's towards the bottom of that spectrum. He's not paid nearly as much as some of his equal sized company colleagues there. He was investing meaningful amounts of money in buying shares in Brightstar. So, he has absolute conviction in that. And when you see someone who lives it, walks it, and talks it, it's the kind of person we want to back.
Thank you. Now, look, let's talk about Caspin. Look, this is a new one
Yep.
that members haven't heard of. And with Caspin, they're actually into tin. And it wasn't until I did some of my personal research that I didn't realize that tin is actually at $40,000 per ton, and with a new gold project. So, can you talk a little bit to us more about Caspin and why you've made this choice?
Yeah, so it's another ding, ding, ding from me. It's another line portfolio stock where we've got a
Mhm.
shared interest there because I know this is something that's crept into the network recently. Um, Tin is a commodity that we like the fundamentals of a lot. Now, we talked about copper. You
Mhm.
take supply out of the market by a couple of mines slowing down. Very, very similar thing has happened in tin over the past few years, and that's tightened the market. It's another one which is very stably exposed to the way that commodities get consumed in the new world as well as in the old world. So tin goes into solder. you want to stick together copper wires to make data centers. There's a lot of solder goes into that. So there's a lot of demand from electrification, decarbonisation, etc., for tin. So well supported commodity. Um, we looked at a number of projects, and
Mm.
when Caspin came to us and we were working through what their picture is, the risk which sits there, and it's quite a clear one, is exploration risk. So, do they keep finding more tin? Can they push themselves over the threshold of being able to develop it? If the price goes up further, you might find that they actually are in the space where they could say they've got a project, but um, I think they've got a lot of area that they want to prosecute to try and extend this. So, we're quite enthusiastic about this being a growth opportunity rather than a development opportunity at this stage. Um, but there's a couple of the particulars of the mineralization which they've got, which attracted us. It's
Yep.
shallow, so you don't need to be mining or installing an underground mine, which is often quite a capital intense exercise to be able to access it.
Mm.
They already have a resource. The resource is open and it's got a very reasonable grade. So, all those things attract. They've done some very early stage process test work. And I don't think that that has really nailed down exactly what it's going to look like when you start to process this, but it's told us a couple of things. And there's what others are doing in the open pit tin space, which probably contribute to this view as well. Um, People talk about ore sorting and they apply this to tin in a particularly
Mm.
successful way. So an ore sorter is a machine that you feed gravel into one end. It's got a very smart computer which thinks very quickly, so it's obviously not me in it. And then this computer tells a bunch of air jets what to do, and it literally can flick one piece of gravel one way, one piece of gravel another way. So you can upgrade certain ores very readily using this. It applies itself quite well to tin mineralization generally because tin is so dense, and it's one of the properties that this machine can sense quite readily, and it can separate this ore from waste, and we've seen results in some tin projects that suggest that you feed in 10 tons at one end, you can
Mm.
get a ton of ore product and 9 tons of waste separated so quickly.
Okay.
Um, the numbers, we need to do more work, I think, in Caspin to understand exactly what that separation looks like. But you do get a sense of confidence that it's going to work. And when that works in an open pit, it's sort of more attractive to us than it is for an underground, because in an underground mine, you want to be mining as little ore as possible to minimize what you've got to cart to the surface, because underground mining is quite expensive. In an open pit, you can take a view, oh, well, if we accidentally take 50% too much, the ore sorter will sort it out. And the cost of doing that is far less in an open pit. So seeing this material, which is susceptible to ore sorting, sits at surface, is within an open pit, and has nice geometries already, was very attractive to us. We were getting into it at a valuation which is attractive, and this has got a lot of near surface upside, which still needs to be tested. So it sits right next to an existing tin project, which is privately owned. Now,
Ah.
I think as time goes on, you find enough material in Caspin. There's a ready-made mine site sitting there. You probably want to
Mm.
rebuild a bunch of things, but you tend to think that there might be a sensible way that you could work together with those people to use the already permitted site which sits there. So we often look for a plan B. Do they have to do a greenfields development all on their own? And the plan B to that might be, well, you've got a neighbour there which might be looking for a way to commercialise their own interests on a very small lease against your own, which shows upside for everybody. So I look at Caspin and there's a lot to like about that on the opportunity front. So the risk is, do you find anything else? The upside is, or the opportunity is, you do, and it's easily upgradable. And there's a mine site there that you might be able to use to shortcut some of the development as well.
And is it true, I guess, at the present moment, there are actually not many companies on the ASX where you can get exposure to tin?
There's one, I'm going to get this wrong perhaps, but there are very
Mm.
few, maybe only one producer, and only a handful of tin explorers. So yeah, if you decide you want to invest in tin, the market comparables aren't going to take you very long, because you probably only get 10 companies to compare to each other. If
Mm.
you're trying to do that in gold, you're still going to be at it when you get to line 500. So it's a much, much smaller space than, say, gold or several other commodity spaces.
Look, and we recently wrote about another company called Stellar. I guess, do you have any comments about that company as well?
Well, Stella's quite well established in
Mm,
that they have quite well understood resources in Tasmania, which is a good mining jurisdiction part of the world. I think the plan B, if you like, that I mentioned before for Caspin, the way that neighbours can come together.
mm,
Stella is reasonably proximal to the big producer, which is Metals X with its Renison mine. I think, and Stella has, as far as I understand it, found themselves. I think it's at memorandum of understanding. I can't remember how far they've actually progressed with this, but they are talking about being able to use a near mine site for their own processing as well. So they might have a plan A and a plan B that you could think about as well. And Stella is reasonably high grade. I suppose where I'd contrast that with Caspin is that Stella's mining is going to need to be predominantly, if not all, underground. Caspin has got that advantage of potentially being able to leverage ore sorting a bit more from ores that you can just expand and take more of
mm.
because of the lower mining cost at surface.
Thank you. Let's move on to Critica. So I was fortunate to meet up with the CEO a few weeks ago. And in fact, Critica used to be called Venture Minerals. And I want to really highlight that shares in value and ECL, we've actually been there from the beginning, and now it's called Critica. So can you share us a little bit more about why Critica is one of your picks and it's one of the biggest players in the rare earth space at the moment?
Yeah, so we had the view we've invested predominantly in gold stocks as we've been trying to take advantage of this current cycle. So we knew there was a weak market. A lot of what we looked at initially was gold, and they always seem to be the cheapest with the most upside. That fundamental has changed a little bit. There's still a lot of interesting gold stocks around, but we cast our contrarian eye over the rest of the space, and we've always had a view that a good commodity thematic, you know, there is risk that comes in, and a lot of people don't see by having to play that via equities because when you do that, any stock that you pick could have stock specific risks which just eliminate all the benefits. You could get the commodity thematic right, but screw up your investing decision, which is what destroys the investing outcome and makes you essentially wrong. So rare earths is one of those spaces that we'd identified as being something that there's a great deal of positivity in wanting to be involved in it. So there's a trade there, if you like. Um, and what we were looking for was a company with a sort of a risk portfolio which matched what we were happy to hold within our portfolio. So needed to be in Australia. That's our
Mhm.
jurisdictional bias at the moment. Importantly, though, by being in Australia, you're in a jurisdiction that is long-term safe as far as big strategic off-takers feel. And rare earths at the moment is a squeeze between China, which controls just about all of the upstream, all of the production, a lot of the mine site supply, um, and the US, which is wanting to secure strategic supplies of rare earths to feed into various downstream technologies. So having a new unconstrained for in terms of offtake deposit, which is very large in a place like Australia, struck us as being quite attractive. So declare my conflict, which you've alluded to. Ding, ding, ding. We own some Critica, and those were the qualities which initially attracted us. So they have a big project. It's attractive because it's quite flat, very close to surface. The mining proposition is not difficult at all. Reasonably high grade for a clay hosted deposit. The question, and this is where the risk exists for Critica, is can you process it? We didn't know that answer when we first invested, but we sort of managed that risk by having a smallish investment, which enabled us to be able to make decisions along the way. We've
Mm,
backed up that investment and followed our money recently, and that's off the back of some metallurgical test work which they've done, which it shows they can leach it. That's the
mm,
first step in a multi-step journey to look at the best forms of processing. And now what we're waiting for is the various other test work processes which they've been running to show us which one they're going to land on to as to how they're going to process this. So we know what processes. We're looking for the optimal outcome there. And if they can show that this processes reasonably easily, and by
mhm.
reasonably easily, I mean for rare earths, it's never a straightforward processing outcome in rare earths. It's a lot harder than this for gold or copper or nickel, things like this. If they can show that they slip in with something which works, all of a sudden they're a large deposit. They're in Australia, so they could become globally strategic from that perspective. They have upside. So the footprint that they have, which is large of the deposit, there's three or four things which look quite similar, and they have a bit of drilling in to suggest that they're mineralized as well. You could have a very, very rich rare earth province in that part of Western Australia, which is well located for ports, well located for highways, gas, power, all those things. So they've got quite a lot going for them. And the final piece, I suppose, that's worth mentioning of that puzzle is rare earth element mineralization tends to correspond geologically with elevated levels of uranium and thorium.
Mm.
These find their way through into concentrates. And when you're trying to sell a rare earth concentrate, it's the uranium content which can make it tricky to transport because it's radioactive. This mineralization has a low level of those, which sort of makes people think, okay, this could be something that you can actually have quite a bit of versatility with. So there's many, many things about Critica that we don't yet understand, and I think Critica is coming to terms with themselves. But some of those high level qualities, big grade in Western Australia, simple to mine, looks like it's processable, are all quite exciting.
And all the macro conditions is aligned, right? The Trump administration recently signed a trade agreement with Australia worth $8.6 billion on rare earths. Because from my understanding is the truth is the US doesn't see China as a military threat, but rather an economic threat. And that's how the war is being played out right now.
Yeah, well, I think the last Cold War was one that didn't elevate to hot conflicts, except in sort of, very localized theaters. And yeah, probably there's a lot of people who feel quite similarly about what we're moving into now. Now, the end of the last Cold War really was the peak of globalization and, all commodity markets becoming global and supply chains becoming global. What we're moving into in terms of a Cold War era is probably just the opposite of globalization as well. So,
Mhm.
those supply chains will separate. China has done a remarkable job in cornering the market for upgrading of a lot of products. So it dominates the world in rare earths processing, but it dominates the world in terms of antimony upgrading, copper smelting, a number of these steel making, a number of these things. So the world has silently and unbeknowingly become dependent on China there. And this is something that the US is trying to now work against, particularly because rare earths feed into some genuinely critical processes, technologies,
Mhm.
defense applications, energy applications, and these are all things which the world wants to not be dependent on China for, and the US is leading the way there. So yeah, it's something that holding an investment in rare earths is not just what's the project value and what could it be worth, because there's a huge optionality inside of that as well that could become something that turns into a completely new market dynamic as time goes on.
Thank you. Now, let's go back, Hedley, to Gateway Gold, which is what we're here for. Can you talk a little bit to us more about Gateway and where that's headed as well?
Yeah, sure. Well, good old gold exploration, because this is something which, investors do love. We don't have a holding in Gateway, and
Mhm.
I don't mean that to say there's a reason for that. There isn't. Gateway, I think we've had an eye on for a very long time. In fact, over the old management and the new management. What's happened in Gateway in the last 6 months, I think in August, they transacted to pull a new project in, and they dealt with a company called Strickland. There's many ex-Strickland people have come across, so it's not only got new project, it's also got new management, and they funded themselves. This is it's not remote, but it is sort of the northern tip of a greenstone in Western Australia, which has been very, very productive further south. So it's known to be a very well mineralized greenstone. Hasn't seen a particularly large amount of exploration up where these guys are. And I think this concept, I mean, I can remember when this particular prospect first came on the map, so to speak, and would have been within the last 10 years. So I know that sounds like a long time ago, but it's not actually a long period of time in exploration. It's got a small resource split between two areas, but they've got these enormous strike lengths of structures, and structures is the key word with gold. You can't really emplace gold without structures. It needs to come up a crack in a fluid. So the more crack you've got, and they've got three very large cracks all alongside each other. And when you start changing orientations and changing chemistries with different rock types, that's what provokes it to fall out and make gold deposits. The things that we don't know about this is there a large accumulation of gold that you can drill and put a mine design around? the positive factors which we see, they've been talking a lot about nugget patches at the surface, and they've been showing little pictures of gold nuggets which have been found. You're not going to mine those gold nuggets, but they're a very positive indicator because they look like the kind of gold nuggets which probably haven't been transported very far in many cases. And gold is malleable. You know, if you roll it, it'll knock all the sharp edges of it. There's some quite fine looking nuggets that couldn't have been rolled. They would have fallen to bits if they had. So, you know, it's probably a bit of transportation involved, but not much. So what it says is X marks the spot. There's something going on around here, and there's enough initial resources to suggest that that's an exciting place to look. So it's a exciting exploration name. The clear risk here is what does exploration lead to? And I can't tell you the answer to that, but you know, there's a lot of signals to suggest that they're looking in a pretty exciting place. And they're a group of people who have the backing of the market. So do they have enough ability to tap that, raise money? They've done that once now. And I suspect that as they deliver news into the market, they'll be able to raise money again and grow that company. So it's a, you know, I haven't done enough work on it to determine what I think the upside is versus the downside, but it certainly looks to have a lot of excitement around it at the moment. And they look to have a couple of rigs working. So I would say the first few months of 2026 is going to be delivery of that news into the market.
I mean, look, you mentioned it before, Gateway, this is a spin out of Strickland Metals. And in fact, we're aware that the managing director has invested something between the tune of $8 to $9 million of his own money. I mean, what's your thoughts on this?
Well, it speaks very loudly of conviction, is the only thing you can say about that. I don't think he knows anything about what's beneath the surface any better than anybody else, although,
Mhm.
you know, he would have made that investment decision without knowing what's in the holes they're drilling now. But he would be pulling together all these signals, all the things that he's seen on the ground, these nuggets, the other data, the information that would be most meaningful to him.
Mm.
And being a person of that means, you know, it's an incredible amount that he's got invested there, but it speaks very loudly for. I reckon this is exciting, you know, and if he's saying that, then he's got a story to tell.
And look, Hedley, look, you said that this is not one of your investments yet. You've looked into it, but you haven't gone deeper. So I'm more curious now about your process. Like, if you were to explore and look into Gateway more, what would be the key indicators that would inspire Lion Selection Group to actually put that into your portfolio?
Yeah. So, I mean, we look at a number of things in companies. People first, and
Yep.
I can't say I know.
Always been people for you, I feel.
Sorry.
It's always been people for you first. I mean, at the heart
Yeah.
of
Yeah.
it, you really back the jockey, right?
Oh, exactly. You know, a horse won't win a race on its own. And, you know, reflecting on my time in Lion, but also, you know, what I know from my colleagues' experiences before my time, it's sometimes easier to change assets than it is to change people in a company. Once they have a job, they don't want to give it up, and for good reasons as well. And, you know, who's to say that just because an investor has come and bought some shares that the managing director or a director should move on? You know, it takes time for rationale about how a company should look in terms of people to change. But, you know, initially the settings suggest that the people who are there are the ones who've got it to that point. And we wouldn't invest if we thought that people are not going to be consistent with our views, you know, share our broad scale beliefs and have a similar view of the strategy. We can't dictate strategy to them. They have to tell us what they think it needs to be, and then we follow them. So it's a very important thing knowing that people are capable enough to progress these investments. So that's the first check on. And look, Gateway, it looks like those people have a great track record already. I don't know them personally, and that's
Mhm.
something we need to do. But then we look at valuation and
Mhm.
risk. And with an exploration company, valuation is a ridiculous concept. You know, I can't tell you what those ounces are worth in the ground because if you find more closer to the surface, well, it's just become a lot more valuable. You can talk a little bit about dollars per ounce and things like that, but you know, at the end of the day, there is no way that you can compare an ounce over there and an ounce over there and say that they should be worth approximately the same on average because they'll be at different depths. They'll be involved with different other quantities of gold, and for that reason, they have different values. Um, I think in the case of this, we'd have to resign ourselves to the fact that if they're going to find gold, they're going to be worth more having done that. And if we think there's a good case to say that they're going to find more gold, then you know that would have to be the support of our investment case. Now, I suppose one thing that we look at is the value of the company, and then what are the prospects for going up. The higher the value of the company and the less you can value them on, that suggests, well, is there a risk in that? If there's a period of time where they slow down, they don't find too much, they're having to think their way through their targeting and lack news flow, that's when that market value can decline a bit. So, is there a better entry? Well, perhaps there is. So one of the conclusions we might come up with a company is we'll wait either for a lower price or for more progress. And that manifests in terms of risk. So risk is the other thing we look at. We've done value, then we look at risk. And the risk is the thing which might prevent your perception of value or the ability for value to be created within the company to then be transmitted into share price. And that can cover a great many things. But in most cases, the biggest risk that we usually see is, can they make a product? Can they sell that product? Can they sell that product for a price which reflects the market value or the market pricing of that commodity? In gold, that's almost a ridiculous concept. You can separate gold more easily than any other commodity, and you can sell it more easily than any other commodity. But in copper, nickel, lithium, it gets harder and harder and harder. And there are projects that we come across where we say, well, we don't have confidence you're even going to be able to make a product here, even if you manage to find it or delineate enough of it. So that steers our decisions quite considerably as well, risk.
Thank you. Now let's go into the final one. In fact, this is actually one of your biggest positions, a Saturn, and it's actually one of our most recommended stocks as well. So I know that last year you actually mentioned Saturn on another podcast, and it did exceptionally well. So what's your take on Saturn now for 2026?
Yeah, well, I don't think it did well because I mentioned it. I think it wanted to be involved, and then it went well. And this is the last of my ding ding dings. We're involved in this. We've got a position in Saturn. It's our largest investment. I think we've invested about 12 million bucks, and on current prices, it's worth about 40 million bucks to us. So we've done well out of Saturn. But having said that, when we look across our portfolio and say, all right, for the ones we can value, who's the most discounted, who's the least discounted compared to their ultimate valuation pricing, and Saturn is still the most discounted compared to the base level valuation that we have in place within our portfolio. So this is a company which it's got a slightly unusual gold asset in that it's quite low grade, but being low grade, it's also quite fat and lends itself really, really easily to extremely cheap open pit mining. So you can take ore out of the ground and put it where you need to put it to process it more cheaply than you can for any other gold asset in Western Australia. And then when you process it, it's suitable to what's called heap leach processing, and that's quite a cheap and economic form of processing. So its cost structure in terms of what is a ton of material worth in terms of its contained gold and how much do you have to pay to mine it and get that gold out.
Yep.
Even though it's low value ore, low grade ore, it's extraordinarily cheap to process mining. So that's where the secret of the economics lie with Saturn, and there's an awful lot of those tons as well. So we saw that when very early in our investing process in this cycle, and we made it our first large investment, and we followed on quite aggressively with that. But we think this has still got a long way to go. And with Saturn, probably the biggest risk here is that is their development pathway fundable?
Yep.
Back when they were a 50, 60, $70 million company, I would have said, yeah, they need to be able to raise the money to be able to do this. That definitely was a risk which you could say could be existential. Having re-rated, they're a circa 250, $300 million company, depending what price and what day of the week you look at them. They can fund their development pathway from here, would be my guess. So they're funded with an exceptional cash balance now. They've got about $60 million in the tin, which will take them right through to the completion of a feasibility study to show how they're going to do this, which puts them in an exceptionally strong position. They've also been able to show recently that there are some high-grade areas within their deposit. I think they've always had the inkling they were there, but they've only recently been able to drill enough holes to show that they can replicate those results and put shapes around them. And that's kind of, I think, broken the nexus for a lot of people in the market to say, well, hang on a minute, there's some ore here which could add, some grade is king to the story. I don't know if small pockets of high grade are going to change the average grade overall by much. In fact, I think it probably won't make too much difference, but it's adding some high value ore to this pot, which I
Mm.
think is, invigorating the way that people think about it. So I said before, Brightstar is one of my picks for 2026. It has had a reasonably volatile 2025, so it makes it really easy to say, hey, that's all behind it for Brightstar. 2026 is the year. Saturn has had a wonderful 2025, and they're up very, very strongly through this year, but they're still very discounted. And they are now in the best position they've ever been to be able to do a hell of a lot of work in 2026. And I think that will be rewarded richly by the market because I think these economics, news of more drilling intercepts, growth of the project are all going to be things that we see next year. So for me, Saturn is the second pick of 2026 for that huge delivery of news coming to the market and the way that people will perceive it. I think it's the year that the penny really drops.
Thank you. Now, Hedley, I want to go on to one more, which is actually Lion Selection Group.
Sure. Story near to my heart, Gia.
Yeah,
Thank you for
yeah.
listening.
Okay, so first and foremost, with Lion Selection Group, when I spoke to you earlier this year in Switzerland, your share, I believe at that point was about 46 cents. And yesterday you finished at 89 cents. Could you talk to us a little bit more about 2025 and the growth that you've had? And then the final question I would have is around, if we have investors right now, we have two sides of the fence. Those that really enjoy, obviously, doing their own stock picks, and then there are those that probably don't have the same appetite, and that's perhaps where Lion Selection Group comes in. Could you talk a little bit more about that, your share price, and why Lion Selection Group, if they choose to go down, going into a basket of stocks with you?
Yeah, sure. So there's a couple of things I want to add to that snapshot of Lion. The first one is we've been a listed company which invests in this junior space for 28 years now. So we've been around doing this for an awfully long time. And if we just take our history back beyond 2025 and 2024,
Hmm.
we sold about 90% of our assets in 2021 and 22. We sold some very large investments there, which took us mainly to cash.
Hmm.
We did that partly through opportunity to sell them, but partly because we were sure that we're at the top of the market then, and the market was going to present much cheaper opportunities after that. And it turned out that we got that call right. So we went into this last bust that we've seen with about $75 million, which we could invest.
Hmm.
We've made money and interest on top of that. So what we've been able to invest is I think we're about $43 million invested.
Hmm.
Um, and that $43 million that we have invested has turned into about $98 million worth of value. So those stocks that we bought for that 43 now worth 98. So that performance has been wonderful. And that has been the uplift largely of 2025 across investments that we put in place in a very weak market. We still sit on about $47 million worth of cash. So we're kind of halfway through our journey of deploying that money. And where we think that's going to go is as much into new names as it is into following the names that are already within our portfolio. We want to remain quite focused. So we've got about 10 or 11 names now, which we see as go forward in the portfolio.
Hmm.
If that goes to 15, I think that's probably enough. We want to focus on those things, be able to really help them with their strategy,
Hmm.
understand our investment, and make sure that the mixture of value upside that we see is not offset against a heap of risk. We want to have an asymmetric distribution of low levels of risk, high levels of upside. And so far, that's what we've been able to achieve in our portfolio. So, and now we've got the boom to see this deliver into. We've invested, let's say, half the cash that we want to invest. We've still got
Hmm.
that to come. I think the next couple of years is going to see that money largely deployed. And we then will have an eye on as we're ticking round towards the top of the cycle as to how we're going to exit some of those positions. And there could be a variety of ways that we're going to do that. Some of them will turn into mining companies. We can decide whether we want to continue to hold them and have a stable portfolio or whether we want to sell them into a market which is quite liquid for them. Some of them, I'm sure, will be taken over. And I don't say that because, hey, we've bought these things that we think are takeover targets. It's fair to say that that has entered our thinking, but we know from previous cycles that big assets, big gold positions become quite strategic when producers are looking for more feed. So, we've got several of those in our portfolio, and I'd expect that some of them do become targets from time to time. So some things will disappear without us trying to sell it. They might be bid for, and then there's others which it might take us more than a cycle to see through as well, presuming that their investment case continues to be presented. So, um, like you said, there's many investors that want to do this themselves, and they're very happy to be investing in the space. They're confident too. What we offer is, a solution to someone saying, I know that high returns can be derived from this space. I can see that people are making 10 times their money, but I don't have the confidence to pick the timing of the market or pick the stocks. And we try to offer that stopgap for them and manage it. All they're doing is buying a share in a company. We're not a fund where you invest in units. You just buy our shares on the market if that's what you want to do. And, the profile of our investors, I would say there are just as many people on our register who use us as an access to that space as there are people who buy our shares and then also buy our portfolio. So we see a bit of both.
Wonderful. And with regards to whenever you do make an investment decision, how involved are you with actually the management of that team so you have direct line of sight?
Well, I suppose we're backing people who we would say that we admire at the outset, and we wouldn't deliberately say, well, we've invested some money here. Now we need to come and sit in your office and tell you how you need to run your business. That's the direct opposite of what we're aiming for. Over time, you find that teams evolve, the skills need within a company changes, and we'll try to maintain a constant dialogue to monitor. How are these people going with it? Is there a way that we can be helpful in terms of introducing people, introducing them to brokers, introducing them to individual people? Is their strategy right? Can we help them to second guess that? There's a number of things that we, might be able to just be helpful people who are there for a conversation, as much as we're incentivized to see their share price go up. So we want to see those settings correct. I think in the past, we've been involved with boards where we've found ourselves on them more out of necessity, where a company has evolved to a point where you need to fill a gap. And one of us has probably been one of the ones on the spot, but you need to hold a lot of shares in a company to want to do that. And I got to say, you've got to want to not do that, because the moment you step on a board, it just brings about a whole new workload, which is distracts you from a lot of other things. So I'd much prefer to not be on boards or have the team from this office distracted by that. There's a couple of very unique cases where we would, and that's just where, because of the way that the company's come about, if we're acting essentially as founders or it's quite early in its journey, then we will be involved and help it to go to the next stage. So there's one company in our portfolio which is that, but by and large, we'd just like to stay away from being involved in boards and trust the people who are custodians of those companies. And as it stands, we're very, very pleased with the suite of people that we're invested in across our portfolio as well.
And how about your team, Hedley? How many is in your team? And I have heard that your team are very stable, and their tenure with you is actually quite a long time. So that really contributes to the stability and the long-term thinking that you actually take with your fund.
Yeah, look, the investment team at Lion is a team of four.
Hmm.
And in the office here, on any day of the week, there's six people. So there's two people who manage the office, manage the company in terms of company secretarial, finance, all those things. And then there's four of us that do the investing work. Of that investing team, I used to be the newest member of that team. So I was 17 years, 18 years in the chair mid this year. And that was me with my fresh face.
Hmm.
We've recruited this year, so we've brought a guy into the team who's joined us from an engineering career in Adelaide, and he's moved across to Melbourne to be part of it. Very, very clever fella. I think a few of your shares in value people met him at a lunch recently in Sydney, where he came along with me and had a great time chatting to a number of those clients. And I said they'd probably vouch for him being a not only interesting, excellent conversationist, but he's also very sharp on the details as well. So Charlie's joined our team, and he's now 3 months into the job. So, but we've seen so little turnover. It may very well be the case that he hits 20 years before we need to recruit again.
Thank you. It's been an absolutely stellar interview here, Hedley. It's always a wonderful time speaking with you. Um, what I'll do now is, I guess we'll see you in 6 months' time, and I'm wishing you a very, very Merry Christmas with your family.
Thank you, Jay. It's been wonderful to talk to you, and I'm really grateful for you taking the time to check in with me. And all the best for your Christmas as well. It's going to be hot here in Australia, and I wish you a white Christmas. I suppose that must be nice, even if it's very, very cold.
It is. Thank you.
All the best, mate.